Welcome to The Explainer. Today, we're looking at a monumental collision. Traditional Wall Street is literally smashing into the world of blockchain, and the result is absolutely fascinating. We're going to unpack the exact mechanics of this shift, how the absolute titans of finance are taking over tokenization, and what this actually means for the future of global markets.
Okay, let's dive right into our agenda. We'll be covering when the titans arrived, why early waves failed, case studies in tokenization, building the tokenization stack, and wrapping up with why tokenization matters right now.
Section 1. When the titans arrived.
Recent regulatory green lights have essentially paved a superhighway for massive institutional adoption. As the quote here highlights, we are now witnessing a profound shift where the world's largest traditional asset managers are becoming the world's largest on-chain token issuers. And this isn't just hype. When you see massive players like BlackRock and Franklin Templeton jumping in, that provides the crucial social proof needed for mass adoption. They've effectively taken real-world asset tokenization from a niche, experimental sandbox right into a core, multi-billion-dollar institutional strategy.
Let's move to Section 2. Why early waves failed.
To really grasp where we are today, we kind of have to practice some intellectual honesty and look backward at the spectacular failures of the past. If you look at the progression, it's pretty clear. It goes from the unregistered initial coin offering boom back in 2017 right into the security token offering bubble of 2018, fast forward past the SEC stepping in to halt major projects like Telegram in 2019, and then you arrive at the compliant institutional adoption we're seeing today in 2024 to 2026. The contrast between the Wild West of 2017 and today's heavily regulated environment is just staggering.
The core issue with that 2018 bubble was fundamentally an infrastructure before demand problem. It's kind of like building a massive state-of-the-art shopping mall and just entirely forgetting to build the roads to get there. Platforms like T0 raised a whopping $134 million, promising to revolutionize trading, but they struggled immensely. Why? Because strict regulatory requirements meant only accredited investors could play, which left secondary market liquidity incredibly thin. At the end of the day, tokenization without liquidity just isn't a liquidity solution. But as you can see, today, we've got deep liquidity, automated infrastructure, and an institutional user base that is ready to deploy capital.
Just to underscore the regulatory reality check of that era, let's look at a massive number. $1.7 billion. That is how many dollars Telegram raised in 2018 from institutional investors for their TON network. But the SEC stepped right in. They established that you absolutely cannot just use regulatory arbitrage to launch tokens into public trading environments without proper registration. Ultimately, Telegram had to abandon the whole project, return $1.2 billion, and pay some seriously hefty penalties.
So the ultimate takeaway from the more than 200 SEC enforcement actions during that era is actually really simple. Compliance with securities law is completely non-negotiable. Now, as painful as that regulatory era was for early adopters, it acted as a massive clearing event. It basically cleared the brush and paved a clean, well-lit path for today's compliant titans to enter the space safely, fully backed by detailed legal opinions.
All right, moving into Section 3, Case Studies in Tokenization.
So, who exactly learned from those past failures, and what are they building right now? Well, first up is BlackRock's Buto Fund. This is truly the institutional North Star for this technology. It originally launched on Ethereum and rapidly expanded to networks like Solana, Avalanche, and BNB. It perfectly integrates systems like Chronicle's proof of assets for unprecedented transparency. But here is its real superpower: double dipping. A hedge fund can earn a stable U.S. government yield from Buto and simultaneously use those exact same tokens as pristine collateral for other digital asset trades in decentralized finance. It's brilliant capital efficiency. Now, what's really interesting here is the sheer velocity of the competition. $2.2 billion. That's the massive supply that Circle's USYC tokenized treasury fund hit by March 2026. It actually surged right past BlackRock's BUIDL to become the largest tokenized U.S. treasury product on the market, and that was heavily driven by its integration as off-exchange collateral on platforms like Binance.
We're also seeing this infrastructure being stress-tested in real time. Take World Liberty Financial's USD1 stablecoin, for example. In early 2026, the protocol faced a highly coordinated FUD attack, which involved compromised social accounts and massive short positions. The token actually dipped to roughly 98 cents, but the recovery was immediate. Within just 30 minutes, it regained its perfect $1 peg. From a purely technical standpoint, this real-world stress test demonstrated incredible architectural redundancy and the resilience of having fully backed reserves across multiple networks.
And the market is rapidly moving way beyond just government treasuries.
Tokenized private credit exceeded $18.9 billion by late 2025, and the market for tokenized equities grew an astonishing 2,900% in a single year to reach around $1 billion. Investors are clearly hungry for higher yield, uncorrelated assets, and tokenization is providing the exact infrastructure needed to disintermediate traditional banking and actually deliver those yields.
Which brings us to Section 4, building the tokenization stack.
Tokenizing an asset actually requires a highly coordinated assembly line of specialized vendors. You've got 5 critical layers here: the tokenization platform, the custodian, the transfer agent, the oracle provider, and the compliance tool. And every single layer represents a critical make versus buy decision for an issuer, carrying massive regulatory and cost consequences. So let's break a few of these down.
At the very center of it all is the tokenization platform. This is the core technical infrastructure. A prime example here is Securitize, the market leader at the institutional end. They don't just provide the tech, they are fully vertically integrated. They act as a registered transfer agent, a broker-dealer, and a fund administrator with an alternative trading system license, meaning they can legally match buyers and sellers. This gives issuers a single vendor relationship that spans the entire life cycle. And this model is so effective that Securitize actually went public on the New York Stock Exchange at a $1.25 billion valuation.
Next up is the custodian, who is responsible for securely storing the cryptographic private keys that actually prove ownership. For regulated securities, this isn't just a best practice, it's a strict legal requirement under the Investment Advisors Act. Anchorage Digital secured the very first federal digital asset bank charter in the US to do exactly this. Meanwhile, players like Fireblocks are securing over $4 trillion in digital assets using advanced multi-party computation cryptography. If you're wondering what that is, it's essentially like requiring multiple different keys turned at the exact same time to open a vault. Then we have oracles. These are the vital bridges feeding real-world data, like prices and yields, directly into the blockchain smart contracts. You have giants like Chainlink dominating cross-chain data and Python Network focusing on high-frequency financial feeds. And let me tell you, choosing an oracle is absolutely not a commodity decision. If you're a fund manager, you are literally trusting that oracle with the financial accuracy of every single distribution made to your token holders.
And finally, Section 5, why tokenization matters now.
Bringing all these threads together, we have to ask, why do the economics of tokenization matter so much right now? Well, the difference is stark. Traditional fund administration is heavily bogged down by paper subscriptions, manual processing, and a high ongoing drag on fund performance. Tokenized infrastructure, on the other hand, utilizes properly audited smart contracts to give you automated distributions, drastically lower marginal costs for each new investor, and the ability to seamlessly expand your investor base.
So the crucial point here is its economic threshold, $50 to $100 million. For very small fund issuances, assembling the tokenization stack might honestly still be more expensive than just doing it the traditional way. But once a fund hits that $50 to $100 million mark, and especially if it expects to scale, the upfront costs of the tech stack are decisively eclipsed by the immense efficiencies of automation. The economics tip entirely in favor of the blockchain.
Which leaves us with a truly fascinating, provocative thought to conclude our explainer. We are looking at unprecedented efficiency for human portfolio managers today. But what happens to global markets when autonomous AI agents start utilizing these exact same machine-readable, on-chain financial rails? The settlement layers being built by BlackRock, Circle, and Securitize right now are exactly what AI agents will require to operate at scale tomorrow. It's a massive paradigm shift, and I really hope this deep dive leaves you eager to learn more about the future of finance